Mr. Vijay Sachdeva, Co-Chairperson, ASSOCHAM, National Council for Corporate Affairs and Companies Law and Corporate Governance, and Head Management and Internal Audit, Chambal Fertilizers and Chemicals Limited. Advocate J.P. Madan, Co-Chairperson, ASSOCHAM Task Force on Corporate Restructuring, M&A and Joint Ventures, and Founding and Managing Partner, Madan Law Offices. Mr. Sudhir Bassi, Executive Director, Capital Markets, Khartan and Co. Mr. Narayan Shankar, Vice President and Company Secretary, Mahindra and Mahindra. Ms. Geetika Anand, Joint President, Company Secretary and Compliance Officer, Hindalco Industries Limited. Good afternoon and a very warm welcome to all of you to the ASSOCHAM virtual session on enhancing corporate governance with SEBI LODR amendments, approval of RPTs and Regulation 30 standards. And my special thanks to all the panelists for sparing their valuable time and joining us in this masterclass. The Industry Standards Forum, formed by ASSOCHAM, CI, and FICCI in consultation with SEBI, has taken a proactive approach in bridging the gap between regulatory expectations and practical implementation. These newly introduced standards provide much needed clarity on related party transactions or RPTs and materials event disclosures, ensuring that compliance remains effective, efficient, and aligned with global best practices. However, as with any regulatory enhancement, the industry is faced with the dual challenge of ensuring compliance while maintaining operational efficiency. SEBI's recent circular mandating adherence to the industry standards note on Regulation 30 further underscores the significance of standardized, clear, and actionable compliance measures. This move is expected to harmonize reporting practices and eliminate subjectivity in material disclosures, providing companies with a more structured approach to regulatory adherence. As we embark on this insightful discussion, I encourage all participants to actively engage, share the perspectives, and seek clarification from our expert panel. The goal is to foster a regulatory ecosystem that is both transparent and business friendly, ensuring that compliance serves as a strategic enabler rather than just a statutory requirement. With that, I look forward to an engaging session and now invite our distinguished panelists to take the discussion forward. Welcome once again. Thank you.
Thank you, Basudev sir. So after this, I would like to invite Vijay sir for his address, and consequently we will move on to the panel discussion. Handing over the mic to you, sir. Vijay sir, please.
Sure. Thank you, Jatin, and good afternoon, everyone. It's wonderful to see that we have a great response to this session. As ASSOCHAM, we have been harping upon on this topic. Any recent regulatory changes, we try to conduct seminars, masterclasses, and this masterclass again has got a good response. Great number of audiences here. So thank you, everyone, once again. Adding to what my dear friend Mr. Basudev Mukherjee from ASSOCHAM mentioned about this, and I'm sure all the attendees are very well aware of the regulatory change. Little background here. So this initiative started way back in 2023, where SEBI invited the key industry associations to create an industry standards forum. ISF has been called. And the task given entrusted to ISF is to create standards which should meet the regulatory objectives as well as should be practical, feasible, and positive, if I may say so. Though regulations, adding the word positive, looks a little difficult there, but that is the law of the land, and that is what you have to comply with. And we do it with positive spirit. That should take care of things. So. Coming back, so ISF came into existence working closely. ISF comprises of lead members from ASSOCHAM, CII, FICCI, and others. And here we are seeing the two standards which have been rolled out to ISF in consultation with the regulator SEBI. So these are around the related party standards and the regulatory regulation 30 standards. Now, the RPT standards provide a very comprehensive guidance on the minimum information that must be disclosed for audit committee and shareholders review, ensuring fairness, transparency, and accountability in related party transactions. And regulatory 30 standards address compliance issues faced by listed entities in disclosing material events, offering clarity in terms of such as value, significant market reactions, ensuring prompt disclosures for critical events like fraud, pending litigations, show cause notices, defaults, winding up petitions, etc. So we thought to make it very insightful and close to real life experiences, and that is where we created this eminent panel and identified some very pertinent questions which I think everyone will be harping upon. So the theme of the panel is around the impact of new disclosure requirements under under RPT standards effective from 1st April. And it is very important to know that a lot of companies, a lot of proactive companies, a lot of large companies would have already taken these approvals with their respective audit committees and boards sometime in January, because that is the good time where you take approvals for the next financial year. And here we have this regulation coming with effect from a week from now. And that is to be dwelt upon that should all these agenda items go back, should take fresh approvals. We have deliberated on this in the past, but I leave it to panel to deliberate on that today and share their views in the sessions. Second is on key compliance challenges for listed entities and guidance to help streamline process to ensure compliances. Third, having said all that, India is growing well. India is attracting great FDIs. So ease of doing business is to be always kept in mind, which is very important for all the industries, all the businesses. And least but not the least is long-term implications for corporate governance in shaping the future of India, Inc., and improving stakeholders' confidence. So with this in the background, we requested and thanks to Advocate GP Madan, my dear friend and co-chairperson ASSOCHAM Task Force on Corporate Restructuring and M&A, and founder and managing partner of Madan Law Offices. We have great set of panels with dearth of experience and real life challenges. Thank you, Mr. Sudhir Basi, Executive Director, Capital Markets, Ketan & Company, for joining us. Mr. Narayan Shankar, the Vice President and Company Secretary, Mahindra & Mahindra. He should be joining sometime soon. And very importantly, Ms. Gitika Anand, the Joint President, Company Secretary and Compliance Officer, representing Hindalco Industries Limited. So with this theme and a great panel, I invite the panel to share and deliberate on the theme with all the audience here. And thank you once again, everyone. And special thanks to Mr. Jatin and team for putting up this event together under the ASSOCHAM flagship. Back to you, Jatin.
Thank you so much, sir, for the insightful theme address, and welcoming all the panelists and guests and attendees for today's insightful session that we are having. And also thank for Basudev sir for the opening address. And moving on to the panel discussion, now I take this opportunity to welcome moderator for the panel discussion, Advocate GP Madan sir. He's the co-chairperson for ASSOCHAM National Task Force on Corporate Restructuring, M&A and Joint Ventures, and founder and managing partner, Madan Law Offices. Along with the panelists, Mr. Sudhir Basi, Executive Director, Capital Market, Ketan & Company, Ms. Gitika Anand, Joint President and Company Secretary and Compliance Officer, Hindalco Industries Limited. And we will be shortly joined with Mr. Narayan Shankar, Vice President and Company Secretary, Mahindra & Mahindra. So handing over the mic to you, sir. Please, we can go ahead with the panel discussion. Thanks, sir. Thanks for joining.
Thank you, Jatin. And my compliments to you for hosting this webinar or masterclass, whatever you call it. Thank you, Mr. Basudev, for your opening remarks, and many thanks to my dear friend Vijay for setting the tone of this webinar. Before I come to this disclosure standard, let me give a disclosure that me, Geetika, Mr. Bassi and Narayan Shankar, both of us are insiders. All of us have been part of this core group, which has actually prepared a draft of the standards. No doubt all of us were representative of the chambers of commerce and industry, whether CII or ASSOCHAM or FICCI. And ultimately, this standard was approved by SEBI, and ISF issued this standard on 14th of February 2025. And the effective date of implementation of this standard was kept as 1st of April 2025. Later on, there were many issues with respect to the applicability of the standard. That standard will be applicable with effect from 1st of April 2025, whether to all the transactions, all the related party transactions, or all the approvals. On that, clarification was given by SEBI, segment-wise clarification was given by SEBI on 17th of this month, 17th of March, if I remember correctly. And on 21st of March 2025, friends, we received a circular from SEBI that applicability of this standard has been deferred by 3 months, by quarter. Now the standard will be applicable with effect from 1st of July 2025. And SEBI has extended this date of implementation on the basis of the feedback received by SEBI from the stakeholders. Now, as I said that right now we are three. Narayan has not joined us. He'll be joining shortly. Mr. Bassi, in our core group, one of the most cool and calm persons. And his one-liners were really, I really appreciated one-liners. And coming to Geetika, one of the most vocal members of the core group. It was a fantastic experience, I tell you, at the core group when we were discussing and finalizing these standards. Though many of the corporates may not be happy, or rather they are giving their comments, criticism, suggestions on this standard. But all of them, we at the core group, we have tried to address all those issues. And still, White's 21st of March 2025 circular, SEBI has also requested this ISF to take into consideration the feedback to be received for simplification of the industry standard, and then release the same in a time-bound manner to meet the revised timelines. So there may be a possibility to begin with this standard is applicable to a particular set of companies, say top 100, 200 or 500. There may be a possibility. I'm not denying that possibility, but no doubt the first date of implementation is 1st of July 2025, and there may be a possibility that to some extent these standards are simplified. And what will the basis? The basis will be the feedback which may be received from the industry. It means now it's open for discussion for the stakeholders to give their feedback. All your feedback will be coming to the core group. And then again, in consultation with SEBI, the core group will be discussing finalizing if any change is required, those changes will be incorporated in the standard. With these opening remarks, before I come to the panel's questions, I request Mr. Sudhir Bassi, the backbone of our core group, if he can give an overview of this standard for within next 10 to 15 minutes, and then I'll come to the questions and queries. And in the meantime, I request all the participants also, if you have any questions or queries, please put it in the, I don't know, Jatin will be with chat box or Q&A. I don't know what system you are following. If they need to write anything, can they do that or not?
The participants can write in the chat box if there are any questions.
Great. Right. Thank you. Over to Mr. Bassi. Please unmute.
Thank you, Mr. Madan, for the nice introduction, and thank you once again to ASSOCHAM for arranging this webinar. What I will do, I will quickly take you through some
just a minute. Yesterday, friends, Bengal Chamber of Commerce also did a webinar on this. And yesterday there was today there is role reversal. Yesterday, Mr. Bassi was moderating the session. I was the panelist, and today there is a role reversal. Yes, Mr. Bassi, please.
We all are used to having a different role on a different day, wearing a different hats on a different day. So what I will do is that I will quickly take you through the time allocated to me on just give me a minute. So just to give you an overview of that I think it is important to understand the background in which this industry standard has come. One can argue that there is already a framework which was available under the master circular, LODR master circular, on what disclosure which need to go to the audit committee and the shareholder when they are evaluating a related party transaction. However, what SEBI felt that the information which is prescribed may not be sufficient, especially from the perspective of the person who is taking a view on the transaction, i.e. member of the audit committee or the shareholders, and also the broader constituent, which includes the proxy advisory firm, because adequate information SEBI felt was not available in that. And hence the whole idea was that how we can provide more information to the stakeholders who are going to approve a related party transaction or recommend to other shareholders to vote in a particular fashion on a related party transaction, and what information should be given to that. And so that was the whole idea of this particular why this ISF is constituted and why this standard has come. The constituents of that was that the disclosure pack, which should go to the audit committee, it should be in a standardized format. It should have adequate information in that. And when I'm talking about the adequate, I will, when in my subsequent things, I will talk about how the standard has tried to enable adequacy of the information, and it should be clear. And then the other idea was that the information should be, because each related party transaction, and that's how the standard has tried to bifurcate into 7 major types of related party transaction, would require a different information to be made available to the audit committee or to the shareholders. And hence, and then only they can evaluate whether the transaction is appropriate or not. And hence, it is different set of information is provided for different type of transactions. And the whole idea is again to enable a informed decision making by the audit committee and the shareholders, and the overall criteria, which in any related party transaction is a concern, is that whether the related party transaction is being done to benefit a related party, which could, quote unquote, could have a impact, could have some amount of influence on the decision making at the company's end in relation to that party. So, and that's why the criteria of whether it is in the best interest of the company or not. I think this is already covered earlier. And how they have now tried to, the transactions have been looked into from a different perspective, because depending upon the value of a particular transaction, the impact it could have on the company varies. A large transaction could have a larger impact on the company, and hence what the standard prescribes are different set of disclosures. One is the comprehensive disclosures, second is the limited disclosure and the minimum disclosure, and we will come to that. And obviously the role of audit committee has gone up. Thereafter, and now the three materiality thresholds which I talked about, the transactions which are the material RPT, the same definition which we have in the LODR has been used here. The second set of transactions which have been identified here are non-material RPT, which are with promoter or promoter group, or with the entity where the promoter group has an interest or concern. Again, the rationale of identifying this separate set was that there could be two types of related parties. One is the promoters and persons relating to them. And second is the other related parties who are not related to the promoters, say a joint venture company, etc. And in both sets, the idea was that there could be a more amount of mischief which could happen where promoters are involved, again going back to the thread of that they could have influence, and hence more information should be given. But for the other transactions, which may be in the more regular course of the business of the company, there could be a scope for regular lesser amount of information. And then the residual RPT, which does not fall in either of the above two categories. And there again, the distinction was created between where the transactions are the value of 1 crore above or below. And there, then there was a distinction which was created to define which are the balance sheet items and P&L items. Again, the thought was primarily to distinct that in case of a balance sheet item, because most likely these could be the large transactions. So again, the scope for manipulation could be higher, and hence it need to go for higher scrutiny compared to a P&L transaction. And now I think this diagram tries to whatever I have spoken earlier, puts in the diagrammatical way, explaining the same. So if it is a material RPT, then there are comprehensive disclosures, and we will talk about them a bit later. And if it is a non-material RPT, but with promoter group, which I'm calling identified person here, then again it gets divided into two parts. If it exceeds this 2 to 5 threshold, which is the same threshold which is there in the LODR for the disclosure of materiality. Therein, if it is a balance sheet item, if it exceeds the threshold, then a comprehensive disclosure, whether irrespective of whether it is a balance sheet item or a P&L item. But if it does not exceed the materiality thresholds under 2 to 5 threshold, then for balance sheet item, comprehensive disclosure, but for P&L item, limited disclosure. And then we have a category of the residual non-material RPT. If the value exceeds 1 crore, limited disclosure. If the value is less than 1 crore, then minimum disclosures. So this is the broad metrics that we have to look at. And how the information is to be presented. Information has been divided into 3 parts. One is the detail of the related party transactions. So related parties. So this set of information introduces the related parties, and that helps the audit committee to identify the relationships, that whether this entity is related to promoter group, whether this entity has shareholding in the company or the company has shareholding in this entity. Because depending upon these relationships, like a company, if I have a listed company as a share, as a JV entity in which is hold 75%, then the transaction will be looked at by the related party in a very different context compared to a transaction which is with the related party to the promoter, but company has no ownership whatsoever in that particular transaction. So the first set of information is trying to introduce the related party. Second set of information is giving basic detail of the related party transaction that the company is undertaking. So this disclosures of row A and row B1 are required to be disclosed for all transactions which are going to the related party, except in B1 in the middle bracket. In case of a transaction which are below the threshold of 1 crore, the requirement is there is one requirement which is not required to be picked up for this purpose, which is the financials of the related party with whom the transaction is being entered to. The third set of transactions is where the details of the specific transactions are to be given, and the details which have been provided in the standards are catering to that particular transaction. So if it is a transaction relating to goods or services, then the focus is primarily to how the pricing has been achieved for that particular transaction. But if the transaction is for, say, royalty, then the focus is that what is the sort of benefit which has been received by the company for paying the royalty to the parent or to whichever party to the parent. So the disclosures in this part are specific for a particular transaction, and hence here again, there was some criticism that, oh, there are 88 line items which are required to be disclosed for every related party transaction. Answer is no. It is the first two sets on this slide which we have to disclose for everything, and the last is only applicable for a specific transactions only, and there you will make disclosure only for those line items which are applicable for that particular transaction. So I think I will stop here, and because the time is here, or Madanji, can I take few more minutes?
Sure, please, you may carry on.
Okay. So I think this is the slide which is the common information about the related party which is to be given in the disclosure to the audit committee or to the shareholders. And if you see broadly, the disclosures are in relation to the, as I mentioned earlier, in relation to the shareholding in the each other entity, the details of the previous transaction, which gives an idea about how important is this transactions with this related party, and also what is the default in the making the in the past transactions, if any. So again, giving a comprehensive information about the related party. And now this is the second are the details of the related party transactions. Okay, here I think all the details are to be given in relation to the transaction. Basically, what is the actual transaction, what is the value, if there any valuation report. And again, valuation report is not mandatory. If there is any, it has to be presented. Then more important is the justification for the proposed transaction. And if we see some of the comments which have come from the proxy advisor when they have given recommendation on the resolutions for a related party transaction, one of the comment which has come that the adequate justification is not given for that entering into this particular transaction. So hence justification is provided. And I think amongst all disclosures which are prescribed in this standard, this is the one of the most important disclosure. And here, this is the place where the company can justify that why it enters into a particular transaction. And I will give you a few examples, one or two examples, like the company as a joint venture entity. Okay, since it is not a wholly owned subsidiary, so it is not the exemption from seeking share of the audit committee approval or shareholder approval is not available. Now the company need to, the way the joint venture is structured is that the other joint venture partner is primarily providing the technology, but we are providing the financial support, whether equity or even if we are giving a guarantee on behalf of them, or we have to arrange the finances. All of those items are something which are required to be done by me. Now, normal course, the expectation would be if we are giving a guarantee for a third party, we should charge a guarantee commission. But here, the charging of the guarantee commission may not be most appropriate thing to do, because ultimately this company was set up with a specific business objective. And now whatever we are doing is to ensure that that objective is met. So now in that justification, the company can provide that information. And this is the reason that we want to give guarantee, but at the same point of time, either we don't want to charge the guarantee commission or it will be very nominal. So this is an important part. And the second part which has come out is the giving the details of the interested directors and shareholder, again giving the rightful information to the audit committee, and the certification which is now being provided that the CEO, CFO, and the KMP and the promoter directors need to give a certificate that this transaction is not unfavorable to the company and the terms are comparable to a transaction with an unrelated party. Now, this is lots of criticism has come on this particular aspect. Is there a need to relook into it? Definitely, based on the feedback which is coming, the ISF will relook into it. But again, I just want to bring out what was the rationale of doing so. Ultimately, the way the whole related party approval was coming up, I think the responsibility was coming primarily on the audit committee to approve a related party transaction. Here, what this standard tried to do was that putting the onus on the persons who are proposing a particular transaction to confirm that this transaction is in the interest of not unfavorable to the company or the public shareholders. So putting a more onus, that was the whole objective of putting this particular thing. And now I will not take time to go through the details of every transaction that we have. I will stop here. So, so these were the details which were provided for various transactions. I think in light of this, I think now the role of the audit committee, though the basic obligation of the audit committee to approve the related party transaction has not changed, that remains the same. And audit committee is the gatekeeper for all related party transactions. But now there are much more information which is available for the audit committee to take an informed call on a particular related party transaction. So that is I think the deliberations of the audit committee will become longer because they will have to digest all the data and then take a view on a particular transaction. So I will stop here and I will pass on to Madan Saab to take it further.
Thank you, Mr. Bassi, for. Again, there's a Jatin फिर echo कर रहा है. Yes.
Right.
Yeah.
Sir, there are some couple of questions from the participants also.
I'll come to those questions at the end. First of all, let me have those questions which I'm having.
Sure.
Yeah. Thank you, Mr. Bassi, for the comprehensive analysis of the comprehensive disclosures mentioned in the standard to be provided to audit committee as well as to the shareholders before they consider any related party transaction for its approval. Now I'll be raising a couple of questions to Geetika. Geetika, before this, one of the participants mentioned in the chat box also that before this we had this November 2024 master circular. And then before that we had July 2023 master circular, which also provided for the disclosures or information to be provided to the audit committee for before it considers any RPT. Do you think that those circulars, master circulars, or the disclosures or information which were provided in those master circulars, was that not sufficient enough? Was that not comprehensive? Or was those master circulars not being complied with by the industry that SEBI had to come out with this standard through chambers, through ISF?
Interesting question. I'll answer it in parts because I think the first part is about adequacy.
Let me give a disclosure. None of the question has been leaked earlier.
Yeah, we are put on spot.
Yeah.
Like I said, I'll answer it in parts because the first part of your question deals with adequacy of relevant parameters as existed even before this entire exercise. The second one talks about industry's presentation of those vis-a-vis its own audit committees and shareholders, and therefore the need for it. If you ask me for the first one, where was it? And before I even answer that, I think I want to state clearly that I would choose to make this on my personal behalf. It doesn't, whatever I say doesn't represent the organization that I work for. And at this point in time, not even the committee that we were a part of. I'm answering purely as a professional and an industry person on my own behalf, not even on industry's behalf. With all those disclaimers, I think it was relevant to quite an extent, barring the exception that the industry would have really understood governance and not just compliance. Meaning, whenever transactions were placed before the shareholders or the audit committee, the list or the relevant disclosures that were mentioned in the master circular or before, they were a illustrative or a mandatory list. Nothing stopped from either the audit committee members to ask for more information, nor the companies to understand a certain matter and therefore ask for a little more information. If you look at the current standard, the format that it is, it has been sensible enough to go into balance sheet disclosures and P&L disclosures, meaning balance sheet and P&L items, to understand that certain transactions may have a little more impact, especially if material in nature, vis-a-vis the others. Now, if you'll ask me, can this wisdom or did this wisdom did not exist in organizations? I would say no. Did all of them not do it? I would say no. Did most of them not do it? I would say yes. And that's where you see the birth of something like this. I think as committee members, while we were also trying to create a level playing field, but it cannot be denied that if anyone goes back and reads orders of housing finance, few housing finance companies and the settlement orders, when you go back and when you look at those kind of transactions, you do realize that there is a gap of disclosures. And gap does not exist just per se a company or per se a transaction. The gap also exists because an investor at the end of the day, SEBI is here to answer to the investors, organizations are here. When we kind of take in money, we're also responsible to the investors. I think the vacuum that lied is symmetry of this information. I may choose to give 20 extra if I belong to a good organization, and someone will give as much as required and write not applicable, not available. If you see those kind of answers, even to the current questions that existed, it's of no use. And therefore, maybe one of the points that you see in the current drafts, I mean, the current industry standards is that no column can be left blank or no column can be left not applicable and you're supposed to give comments, is because people have tried very convenient ways of filling up information also as it existed. So therefore, I think while the existing norms were relevant and adequate, I still believe that industry can definitely or should have taken a little more steps towards being a little more upfront in disclosing, at least for material transactions. And that's where the gap existed. And I think that's the gap that they've tried to fill.
Okay. You talked about gaps and vacuums in housing finance companies. We have seen such examples, and those examples started way back in 2008 when we had this, one of the major scams in the country. Satyam, then Diwan Housing, then ILFS, and many more. I'm not going to name all of them. And I, being a corporate lawyer, particularly in the field of insolvency, I see it in before the adjudicating authority that all the, I'm not saying some of the or most of the, I'm saying all those insolvent companies have become insolvent because there have been siphoning of funds, there have been diversion of funds. The resources of these companies have been used through other entities, and the route is one only, and that is associate companies or related party entities. There is no other second route.
Yeah.
In all those companies, these companies become sick because of that reason only. So what has actually happened, barring large compliant companies, I use them as exceptions. Barring exceptions, in almost all the companies, wherever the diversion or the siphoning of funds or siphoning of resources has been there, all that is through the related entities or associate entities or whatnot. So according to me, I think it was imperative for SEBI also to plug in all those loopholes, to block all those holes, through which, no doubt, all the listed companies or all the good large compliant companies, they were already complying with this. There was nothing wrong with them. This is an additional compliance burden on them. There's no doubt about that. But,
Yeah.
but I think that there cannot be any exception, that because right now we say whenever SEBI comes out with any amendment, that first of all it will be applicable to top 100 companies or top 500 companies, but it never says that it will not be applicable to top 100 companies.
Yeah. Yeah.
That has never been there.
Yeah. Yeah.
If any
Yeah.
issues with the large companies, certainly SEBI cannot give such exemption to large companies.
True, true.
So they are every time, whenever a new amendment comes, all the good governed companies are additionally burdened with this new fresh compliance.
At least that's how it comes across.
Yeah.
Maybe I'll add to your point, which is you made a very interesting point.
Hmm.
As I believe that RPT is one of the parameters of governance, corporate governance.
Yes.
And one of the pillars of governance is transparency. And that's where, this entire exercise is leading towards. While that is on one side to say, here are the basics and here are the parameters to how you do it, I would also maybe highlight that we are, there is no denying, especially when we look at whatever has happened in the last 3-4 years in multiple such parameters, not just RPT, that we are a very heavy disclosure based regime. And while that works for our economy and there are stalwarts taking those decisions, however, what I feel as being one of the persons who's experienced in one of those top, whatever, 150 or 100 companies you say, is that I've always realized that where things have come, they've been applicable, top 100, it's all disclosure based. And we raise a little hue and cry in the beginning, then we all iron out, we ease out, we comply it. But I genuinely feel that enforcement is not picking up gears the way disclosure does. And maybe somewhere, therefore, we need so many amendments to continue putting it in people's head that transparency is important. As any other practice of law, a practicer of law, I would say, do we have equal amount of enforcement? So I would say, fine, you've added more disclosures, I'll do more disclosures. What happens to the person or to the organization who's not done and thereafter it comes? We see some orders and then we see a lot of settlement orders. So I'm just kind of leaving that point here to say that a balancing act would be nice, because someone from good organizations being a part of top from 50, 100, 500, rolling it out, taking the additional burden to handhold with the lawmaker to make the economy responsible, also wants to see somewhere those being punished for whom the entire burden falls on certain entities. So just leaving that point, that I somehow feel the balancing act could be a little more better in terms of disclosure versus enforcement.
Thank you. I also welcome Mr. Narayan Shankar. Narayan, can you please open your video if possible?
Yeah.
And friends, if I'm putting up some question to one panelist, it doesn't mean the other co-panelists cannot respond to that. Even Mr. Vijay Sachdeva, you are also free to respond to the questions. Okay, Mr. Narayan, do you think this behind these standards, is there any role of proxy advisory firms? Because Mr. Bassi touched upon this role of proxy advisories. Because day in and day out, they come out with their reports on the basis of the notices of the AGMs and EGMs being issued. Whether some of those reports are responsible for this standard? What is your view?
See, majority of the proxy advisory guidelines are already available on their website. And the points which they have been mentioning, that means the guidelines which they use while assessing the company's related party transactions, correct? And many of those things where they've been making a mention of a promoter group, or additional information which they require, many of them have also been, what I'm saying, and the basis on which many of them have been getting adverse recommendations, correct? Whether it is this clubbing of purchase and sales, or clubbing of any opposite transaction as one transaction. This proxy advisories have always been raising it time and again, which you today find it coming in one way or the other. Correct? So in a manner, I will really say yes, many of the points which they have been mentioning about disclosures, many of the points which they've been mentioning about thresholds, materiality thresholds, earlier also absolute amount not being there. Everything you find, many of things will come as part, like at a particular point of time, what is good to do tomorrow becomes a regulation, and so on and so forth, correct? So any of the cases where you see one bad conduct of a corporate leads to also one bad law. That's the law of karmic accounts when it comes to corporates, correct? So if you have one particular group where the subsidiary is used as a conduit to siphon funds, where the promoter is the ultimate recipient of that, you will say that every subsidiary and every associate or a joint venture where disclosures are there, we all will have to have that regime in place, correct? But yes, to a great extent, many of the points which the proxy advisories have been asking from time to time, many of them they have been writing to SEBI, and including those where they felt that it has not been all that great, and yet those things were passed on, and rightly so, many of them have come.
So now, if I put a very crude question on this, how the industry is rating these proxy advisories? Are they anti-industry or pro-industry? Or this, or can we call them just simply pro-investors and anti-industry?
If they want more disclosures, I don't think industry is against that at all. I don't think either me or Gitika, you'll never find us to say that we are not ready to disclose. More the disclosures are merrier, correct? Okay. Earlier we had certain issues where you're going beyond the act and where you are talking about certain governance, and governance may differ from company to company. And there the point was really that if it is merely a governance concern and it's a red flag on certain things matter which you perceive as non-governance and the company may perceive it otherwise, that's been a dialogue which we've been having with proxy advisors time and again. But it's not that if you're for the promoter, for the shareholder, it is anti-industry. That can never be the case, correct? Because if they are for the shareholders, the companies equally are. Majority of the companies today, if at all it is demanding that type of premium in the market, definitely shows the level of disclosures, the level of governance these companies also have, correct? So it's not that they are both not syncing together. That's certainly not the case.
Yeah.
Mr. Basi, do you agree with what Mr. Narayan just said, that more the disclosure is merrier? Because more has no limit and more is subjective. Today, what is more, tomorrow it may be less. So is it necessary to always to prescribe more, or the company should be having the discretion to disclose whatever is required to be disclosed? Or should there be a particular standard or format or regulation that this is the minimum disclosure?
So this is a chat we've been having with SEBI from time to time, that there are two ways of legislating law. One is which we call generic principle based disclosure, and the second which we call is prescriptive, correct? And SEBI has been very clear. They are very not comfortable with just going on a generic principle based. They are the cases which come before them and the other matters which come before them in a manner leaves them with no choice but to be prescriptive to the core. So we have like it or not like it, the regulator has today chosen a path of saying that we will get into prescriptive lawmaking, prescriptive disclosures, prescriptive regulations, correct?
Yeah, Mr. Basi, your views on this? You're on mute.
So what I totally agree with what Narayan has just said. The point is that are we as a country ready for a principle-based regulations? And if you see today also, the LODR starts with principles. And tell me how many people try to read those principles and make disclosures based on that? We don't. We follow what is there prescribed in the different chapters and in the annexure in the master circular. We make those disclosures. Principles we have to bring to the attention of the practitioners that, oh, this principle is also there. So I think it depends on us as the corporate and as the persons who are implementing the law, that we give confidence to the regulator that you can come to a principle-based regulation rather than a prescriptive-based regulation. And that is the whole reason that we end up having multiple amendments to the regulation, because a situation comes, and that is again an unfortunate part in India, that, and which I'm taking a thread from what Geetika said earlier, that a situation comes, easy fixes change the regulation. Easy fixes not to enforce what you have on that particular day. I think, but as I see, based on what I have seen in last 30 years, we have come a long way. Okay. And now there are a large set of corporates who, in any case, even prior to these standards, were giving more information than what was required under Master Circular. And I think more and more companies will adopt that position. And now we see that the situations which were earlier, say 5 years ago, many of the companies will say, kar lete hain, dekha jayega, we will manage. Those things have changed. Okay. Now there is and I don't want to use the word fear, but I think there is a realization that there is a benefit of better governance, and even the markets are giving better multiples to the companies which are governed better. And it is in the form of the multiple, it is in the form of the type of investors who are investing in those companies. Other day, I was having a conversation with a company, and they said, Ki aisa kar lete. I told them, because you decide where you want to make your money. You want to make your money in enhanced market capitalization, which will give you 20 times what you are going to make here by this one-off transaction. And they understood immediately that it is much better to follow the law, not try to do something in which we will make a one small time gain, but the sort of impact it will on the reputation, you can wipe off that gain multiple times in terms of the loss of market capitalization. I think we will reach there, and I don't see that day far off, when most of the companies will be giving information which is required as per the principle uh, and as per the spirit of the regulation, rather than tick box approach, de diya, de diya, de diya.
Good, thank you. My appeal to the participants. Somebody speaking? Yeah, my submission. I'm not going to ask any question. Jatin, can you please mute yourself? I think some sound from your side, or maybe from Ashok, co-host. I'm not placing any question on the contents of the disclosures in the standard, because as this standard may undergo some changes, so I'm not putting up any questions on those. Geetika, a couple of maybe around 5-10 minutes ago, you said that no column should be left blank. Does it mean that we can have the comply or explain approach while giving the information to the audit committee or the shareholders?
Yeah. That's exactly what it means. And also, I mean, comply or explain, principally, yes. But largely coming from a point where there is also difficulty in disclosure sometimes. Like we said, the rollout of these standards were pretty fast, and therefore some of the bleeps that the industry faces is that if they have foreign entities, if they have organizations which do not have symmetry in terms of either financial calendar or a financial year or calendar year, or asymmetry of information from accounting standards or regulations applicable in a certain country point of view, you may not be able to find same disclosures here or in the time that you need. Even in that case, the least one can do is comply or explain. The least. And I'm also assuming it's coming from the fact that per se related party transactions are not bad. Only if there is a smoke that you are not able to detect because of the lack of information or actually a problem, then it's bad. So if you really want a transaction and if you can't justify it, then there is genuine problem. Otherwise, you could always comply and explain.
And just to add to Geetika, the standards itself provide that you need to fill all the columns, but if some column is not applicable, you can say not applicable, you can fill in nil. The whole idea is that you have considered all the columns and provided the information wherever it is applicable. That was the whole idea.
Not applicable is still fine. But some places it is applicable, but you could not provide the information. There comes this question of complier. Explain.
I think
No, sorry, go ahead.
No, there also, I think, what are the difficult parts, like on the bids, valuation reports, etc. If you see the line items, it provides that if it is not obtained, please explain. Okay, it's not mandating you to do all those things, but if right thing is to do that, but in circumstances it may not be relevant, then you explain those circumstances. The standard is considered. Over to you.
Yeah, Narayan, you were saying something.
Yeah, no, what I wanted to say is like, so just to supplement what Sudhir is mentioning, there are many places where there is a clear mandate of even giving comments of the audit committee, correct? Specifically, suppose if a valuation report is required and if it has it been considered, if it has not been considered, what is the basis? And if it has been considered, what is the basis of the valuation, correct? Similarly, if there is a requirement of, I think, number of bidders to be 3. If it is less than 3, audit committee today is required to comment specifically whether the number of bids quotation received are sufficient, and whether audit committee is going to provide justification if you are rejecting the best bid but selecting a related party which may not be the best bid. Then justifying, for example, additional cost to the listed entity vis-a-vis the best price, correct? Similarly, even for financial transactions, if the interest rate, for example, Madan, is charged to the related party is less than the average rate charge, then the audit committee today has to provide justification for the low interest rate charge. Credit rating you talk about. You talk about related parties. Multiple cases which had come up is that the related party has defaulted in repayment of loan. Their credit rating has gone 2 or 3 notches lower, but yet the listed company is continuously giving the same loan. So the question is, it may happen that you still have to give, correct? The company may not be your subsidiary or associate may not be. The standard today requires you that, for example, if the related party in the past have, for example, defaulted, at least make a mention, the audit committee has to justify why it still requires funding, correct? Similarly, even investments, if your value of investments is diminishing, or many a times you have negative returns, correct? Then again, audit committee needs to justify. So there are multiple checks and balance along with the intimation to say these are the places where audit committee will have to compulsorily make a comment or justify whether it is additional cost, whether you're rejecting the bid, and so on and so forth.
Okay. My next question to you, Narayan. Since the introduction of the standards, many questions have cropped in with respect to this certificate to be given by the promoter director. Who is this promoter director? Who is the promoter? Why this certificate is to be given? Particularly in those cases where the promoter is an entity, promoter is not an individual. Who shall be considered as promoter director? What sort of certification is to be given? Because there may be a possibility that all related party transactions, promoter is not a party. Promoter is not interested. So why this concept of promoter director certification has been issued, has been incorporated?
So the first point was that not getting too much into the deliberation, the first point was how do we really carve out which are the additional disclosures required in case a promoter is involved, correct, directly or indirectly, or making some benefit to himself by way of this. So the key point was, if along with the CEO and CFO certificate, if you have a promoter director, that promoter will also give a certificate similar. There are multiple things which is mentioned in the ISF where he has also to give that certificate. Second, coming to your point, is it only for transaction where the promoter is interested, or is it for all? The answer is currently the way it is, the ISF has come out, it applies to all. It's not that he is going to give a certificate only for items where he is directly involved. So even if it is a holding and subsidiary vanilla transaction, the individual promoter or the promoter entity, whichever you call, body corporate or individual, sitting on top of the holding company may not be involved. Correct? Yet he will have to end up giving the certificate. Representations have also been received even as much as even last week to see whether we can consider only those those items where a promoter is interested and not to give it to all. Second, also recommendation which came is, if a promoter, individual or an entity directly or indirectly is involved in a transaction, even through his body corporate, even then it's fine for the promoter to give. But otherwise, it's a vanilla transaction between a holding and a subsidiary where the promoter is not involved, need not be given. But the key problem is definition of promoter, correct? You can either go definition by the ICDR route, or leave it of saying that this is it, what we want, and additional tagging of those 2% vis-a-vis the related party. The key point which is coming out is that even if it is a subsidiary when it is filing its annual return will show the holding company as the promoter. So those even holding and subsidiary, so long as you're a promoter, you also get tagged along. So you'll have to make those additional disclosures.
Geetika, your comments on this?
Sorry.
I think it's the rule of universe that when Shankar speaks, it's the last point. Shiv ke baad kuch nahi hota. I think he summarized it so well that there is nothing more that I can add.
But I asked this question to Narayan, not to Shankar.
Imagine he's a combination, more deadly. What more do you need? But no, I would have not added anything more. I think he summarized it beautifully.
Okay, then
only
I put
one point which has come.
Yes, please.
I think we lost him.
He's the ultimate, you know. Anyway, in the meantime,
The subsidiaries. Hello, you are able to hear?
Now we can.
I think everybody went out and blank. Okay, sorry. So what I'm saying is, many a times the parent company may not have the main listed entity may not have a promoter identified. Many corporates are there, even in Sensex, there are no. However, when these companies have promoted further companies, it is getting applicable to them also. Although the main company may not have a promoter, but the listed entity has promoted further companies down the line, it will still apply. For the subsidiary, this is the listed entity is a promoter. So there are multiple variations even to the promoter where people are facing.
Maybe the only point I can add is that let's hope that when we go for public comments, we are able to hear from public these multiple situations where they are confused. Correct. Which can be clarified enough. Absolutely. Because there's a lot of anomaly here because of the multiple structures that Indian corporates have. Correct. So it'll be good to have a lot of clarity in this area.
Yeah.
Does it mean, Mr. Basi, that ISF will be coming out with some FAQs on this standard?
The idea now is that since the SEBI has requested that the ISF to have a relook at the standards, and currently ISF in the process, and I think these type of seminars are giving us very valuable inputs for ISF to consider. So some of these clarification can be part of the revised note itself. FAQs I will reserve for the things which are once the document is out and thereafter people have clarification. But our objective at ISF would be to consider all these things, and wherever the difficulties have been expressed, okay, how we can take care of them in the industry standard itself rather than going by the FAQ way.
Okay. Now, Geetika, next question to you.
I can maybe just input. Yeah, there's an echo. Yeah. If I can intercept to say that I can see, Mr. Madan, you're enjoying being a moderator and being on the other side and asking questions. And each time you ask a question, you smile. So I can get it where you're enjoying being on the other side.
Yesterday, Mr. Bassi had this luxury.
Yeah, please go on. Sorry.
Now, next question is with respect to the CEO and CFO KMP certification. Now, if there are multiple KMPs, who will give this certificate and what shall be the basis of this certificate?
The straightforward answer is that between the KMPs also, multiple KMPs if it exists, it should be those KMPs who are actually both from a duty boundness required to have legitimate information on the transaction and therefore certification, plus not just from their individual professional capacities have the information, but also answerable to audit committee should be the ones signing it. That's my plain principle based answer.
Yeah, but Madan, if you see the certificate, hello? Again, there's an echo, I think.
Please carry on.
Yeah, if you see the certificate which is required, the certificate is required by the CEO, from the CEO or CFO or any other KMP, and from every director who's a promoter. So the listed entities have been given the choice. It could be a CA, it can come from the CEO or CFO or any other KMP. But along with them, a promoter director is a must. And that too for limited, that, LODR does not have the principles of arm's length business, correct, which is prevalent in the Companies Act. So the KMPs or a CEO or CFO and the promoters have to just confirm that the RPTs have been entered, are not prejudicial, terms and conditions are not unfavorable to the listed entity, and so on and so forth.
Narayan, if there are more than one promoter director in the company, whether all of them are bound to give this certificate?
They can decide.
Normally need to be, the wording has come. It says, oh, you can read it to mean all directors, but this is an anomaly which need to be corrected.
Okay, great. Mr. Bassi, my next question. Again, why there's Yeah, Mr. Bassi. First of all, there was a requirement that only independent directors at the audit committee will approve the related party transaction. And now, through these standards, there are further obligations on the same independent directors who are members of the audit committee also. Though it talks about audit committee, but invariably it will be on the independent directors. Do you think the disclosure which are to be made pursuant to this standard, it is actually going to enable them to take a cautious decision, to take a judicious decision, or is it going to increase their role or the responsibilities or ultimately the liabilities of those independent directors?
So as I see that and that I've mentioned earlier also, that has the role of the audit committee has changed? Answer is no. The role of the audit committee has remained exactly the same, to approve the related party transaction. I think what this standard is allowing them to do is to have more information at their hand to decide whether this transaction they should be approving it or not. Can an audit committee member could have taken a view in the past, oh, limited set of information was available, I approved the transaction, and but something goes wrong tomorrow, I will not be liable. Answer is again no, because as a member of the audit committee, you had all the right to ask more questions. You had all the right to say that, oh, I don't have the information, please give me the information, and please defer the agenda, and we will again meet once we have received the information. Now, what this standard is doing, that it is providing, I believe, the rightful information to the audit committee to take a view on the particular transaction. So I see it as strengthening the heads of the audit committee, but at the same point of time, I don't see that the responsibility of the audit committee or the obligation or its liability has changed in any manner whatsoever.
Has it not increased the burden of the independent directors?
The independent directors are the poor chaps in any board as of today. Okay, the sort of the transactions which independent directors are supposed to approve. Okay, like these related party transactions, or they have to give their they have to give their recommendations on the scheme of arrangements and number of other situations where the role of independent directors, SEBI is mandating that these particular transactions need to go through independent directors only, or independent director should have a majority on certain committees. So the role of independent director is enhancing day to day on everyday basis. And I don't see that being changed in near future. It will continue like this. And based on some experience, some more things will come on the heads of the independent directors. I think it is the responsibility now of the independent directors to not to take decisions which are informed decision, ask questions as many as possible, and in certain situation even may ask the company to get them independent advice on certain particular situations. That I believe independent directors need to do, and they cannot just run away from them, because SEBI is seeing them, independent director is trying that the persons who don't have any connection per se with the company and they have no other pecuniary interest. So they are the persons who should not have any reason not to ask questions. And that is the responsibility if have been put on the independent directors. Then I see them holding a very difficult position. But I think the things are again changing. And as I said, the more and more the corporate behavior will change. Okay, the life of independent directors will continue to will evolve, and it will become easier.
Okay, but I'm putting on a different question to all the panelists. Yesterday, I was addressing the board of a very large listed company from railway sector. And I was shocked to see that there is only one independent director and there is no woman independent director on the board of that company. The reason was that with the government, the good number of independent directors are not available. I don't know whether that was the right answer or not. That being the case, if that is the scenario, then do you think, I'm asking this question to all three, do you think tomorrow can there be a situation where this good number of independent directors, they start leaving the boards because of these standard like this, or they do not give their consent to because too much of compliance from the government? This question has got nothing to do with the information to be given to audit committee. But
No,
the
so
question
here
is,
again,
what will happen later on?
no, I will come in first and I will talk in relation to these standards. Okay, what these standards try to do, and that's where the whole point on this CEO, CFO certification and promoter certification comes. Okay, that the independent director should not be left holding the crying baby in its hand. So the proposers of the transactions, and if the promoter is involved, and that is a debatable point as we have debated earlier, is interested in that transaction, those two guys also have to put their neck out and say this transaction is the right transaction for the company to enter into. So I think, and those are the sort of things which are going to change the behavior. That is my feeling. Where and unfortunately, that has been the experience of SEBI also. Like nobody was bothered complying with the minimum promoter contribution. But the day SEBI came out with a law that we will freeze the shareholding of the promoter within 2 to 3 years, almost 95% of the companies become compliant. Okay. Here also, now the onus being put first on one of the CEO, CFO, or KMP to confirm, give this undertaking, and then this undertaking is being considered. I'm not taking away the responsibility of the audit committee, and audit committee should not be saying that I relied just on the undertaking. They need to do their own work. So that is the sort of comfort that is also being given by the management and by the promoter director, that yes, we are also standing behind this particular transaction. I will.
Geetika.
Yeah, just a few points to add. I think he's right. And also because Mr. Bassi is a principle-based person versus, norms-based person. So I agree when he says, from a principle point of view, the duties or the responsibilities of the audit committee members should not have changed, because at the end of the day, it's the same transaction with different information that is being placed. Does it give more power in their hands to ask for the information? Yes, because even they are supposed to give a certificate which says that the information provided to me was adequate to, certify a transaction. Let me look at a different side. Assuming that this law is not for the companies who were anyways disclosing, this law is not for the audit committees who were irrespectively looking at transactions. If it is for those companies that we know it is for, will those audit committee members still be hesitant to sign that certificate? Would they be stronger enough in asking for this information? Meaning to say, does the burden, the onus of the burden, does it shift in the cases that SEBI cites for being the cause for creating these standards? How many of those settlement orders mention any kind of charges or anything towards the audit committee members? Not covered under DNO. So I'm just trying to put all those food for thought, all that food for thought in your head, that all story said and done, what happens at the end of the day? At the end of the day, it's one more certificate that gets signed by a KMP. And I'm talking of organizations who've not taken it seriously earlier, because of whom we have these standards. Are we sure that they'll take it seriously because we have one more certificate? We don't know. But it's one more KMP certificate. It's one more audit committee certificate. And the ones who are taking it seriously, the only difference it makes in their life is the time that they used to spend in looking at disclosures with respect to RPT. That does change considerably. There's no denying that. And coming to the point, the second point that you were mentioning, Mr. Madan, is will they be shy of getting on boards? The responsible ones, yes. I think their due diligence will increase and should increase. If I would say, if I was offered an audit committee member or a chair of a committee of a company tomorrow, I would want to look at the kind of RPT disclosures it has made in its last AGM notice, because I'm going to get held back for it. That's possible. So maybe the due diligence that they should do should definitely change if they want to do it responsibly. That is obviously the fundamental.
Okay, now my last question to you, Geetika.
Yeah.
So you belong to one of the large and the best compliant company, one of the best compliant companies. But post introduction of these standards, you have, I think, been part of the panel, or you have faced many questions at different forums with respect to the applicability of these standards. What were the reasons of those questions or the criticism of the standard? Was it something to do with the process or procedure to be adopted, or the companies didn't want to be compliant, or they don't want to be transparent, or according to them, this information need not be supplied to the audit committee, and audit committee you take the decision without this information, or it is very impractical to supply this information? What were some of those reasons?
Okay. I just lost you at the end. Can you listen to me? Am I audible?
Yes.
Because Madanji, I lost your voice. I
You
don't
are
know if it's to
audible,
do
but
with my
I hope
system.
you. I hope you
Anyways,
have
if I'm
understood the
audible, I
question.
go ahead with the answer. I heard your question and I could see
Yes.
it in the transcript as well.
Yes.
I think there are 4 main points to the reason of opposition or criticism, whichever way you say it. I'll classify into 4 pieces. The first main piece was lack of public consultation. Second was the speed with which this was brought into force and asked to be complied with. The time gap, the speed was very less. Third is it is obviously a resultant outcome of the second one is that if you have to, for an organization of larger size and complexity, gather this information in a period of about 20-30 days by setting up protocols, by setting up processes, you will realize that most of these bigger organizations would have accounting softwares, etc., etc. You need to load up stuff because the number of transactions, average transactions these companies would have is 1,000, 2,000, whatever. So to identify, understand, put in B1, B2, and etc., you'd have to put it in the system. Setting up of processes and controls at the very fag end of a financial year is not that easy for all organizations. That, I believe, was one of the reasons, the third reason for opposition. And the fourth one, I believe, is that's something that's a constant, I believe, is there's never been a bridging of gap of awareness between regulators and industry. Meaning to say, if I was on the committee, and you remember I was on the committee, I asked, why do we need this? Do we really tell the industry why? Because those who are responsible would be willing to hold your hand and walk through. But most others, because they don't know the why, in as much, they are like, they feel burdened. That is this relevant? Do I need this more? Did my audit committee ask? My shareholders did not ask. My transactions did not have oppositions from proxy, or my major shareholders did not tell me that I don't do enough practices. So fourth, therefore, to me is lack of adequate awareness on the why of the regulation. So that to me are the 4 possible reasons of opposition, criticism, whichever way you call it.
I think all these issues stand sorted out now by virtue of this March 21, 2025 circular. And I always say that whenever I always tell the regulator and the ministry also by sitting in Delhi that whenever a new amendment comes, no doubt, first of all, there has to be a discussion paper on that. And secondly, the moment this amendment comes or a new legislation comes, there has to be due advocacy of the particular new change or new amendment.
Yeah, I said awareness, but you're right, advocacy.
So that's the need of the hour.
Yeah.
Thank you. And Mr. Vasi, yesterday we discussed that if we need to revise or update our guidance note on related party transactions, which ICSI SSB has come out. So yesterday itself, I spoke to ICSI president that now we have 3 months time. If we within 3 months, if we can update our guidance note on related party transaction, taking care of this latest standard. And he was very, very responsive, and he said he will take up this issue at the earliest, and hopefully before 1st of July, we have the revised, updated standard in place, the guidance note in place.
With maybe hopefully enough consultation and representation and advocacy.
Yes. And Geetika, you raised one question with respect to foreign companies. I think one of the questions was there in the chat box.
I also saw it.
That way, if a related party transaction is with a Chinese company and the Chinese company is not ready to disclose anything, how to handle that situation?
Regulation 5 is your
So
answer.
the Chinese company will say that we are bound by our own local laws, not by Indian laws.
Yeah.
But certainly these disclosures have to be made here.
But Regulation 5 is your answer. I mean, the amended Regulation 5 under LODR, which came up in the about 4 months back, which said that if there is a duty on other parties connected with a listed entity in terms of disclosing, which enables the entity to disclose, they are duty bound to provide that information. And to that extent, the onus shifts. So Regulation 5 is your answer.
So it means Chinese company are bound to share that information.
Yeah.
With this, we come to this. Yes, Mr.
So that was the whole idea of Regulation 5, that you are putting some fire under the other parties who are supposed to give you information to comply with LODR. So that was the whole idea. But then China is not in the hands of anyone. So
Yeah.
we have to live with some of these situations.
Yeah.
So thank you very much. Thank you, Narayan. Thank you, Mr. Bassi. Thank you, Geetika, for wonderfully answering all my question. And Geetika said that today I'm playing a different role. I'm enjoying playing that role. But you know, I'm being punished also for that role, because the beginning of the webinar I saw Mr. Bassi enjoying his tea, and you were enjoying your milk or lassi, but I am with the water only.
Yeah.
So that's a punishment to the moderator.
Yeah. No, it's always a privilege to be with you on the panel, Mr. Madan, and it's the first time with Mr. Bassi and Mr. Sachdeva. Thank you for having me.
Thank you. Over to Mr. Sachdeva.
Thank you so much.
Thank you so much, sir. Thank you. As we come to the end of the session, I thank all for an enriching, insightful contribution from the panelists, and Vijay sir, Basu sir as well, and special thanks sir for taking out time from your busy schedule and moderating the session. Madan sir, thank you so much. Thank you so much. And last but not the least, our participants for an active participation through our questions. They have put it to the panelists and have an engaging session today. Thank you, sir.
Jatin, during this interaction, I've tried to take care of all the questions which were there in the chat box. So according to me, none of the question has been left, and some of them were suggestions. Now there was one question which is for Mr. Bassi, that whether his PPT will be shared with the participants. I think that's up to Mr. Bassi. If he has proprietary issues, that I will leave it to him.
No, sir. The whole, as we discussed on the call, that we need to do more advocacy, more awareness. I will share it with ASSOCHAM, and they can share it with anyone they like.
Great.
Mr. Bassi, can I request you to take a specific point by one Mr. Sanjay Sharma, who's saying that why can't we give relaxation to the companies which are compliant based on past track records? It'll be a very interesting comment to have. Anyways, on a lighter note, thank you so much. It was lovely to be around.
Thank you very much, everybody. Thank you, Mr. Bassi, for your generosity to share your. Thank you.
Thank you. Thank you so much.
Thank you.
Bye-bye.
Thank you.
Thank you all.